Industry experts are warning that the worst is yet to come. The Reserve Bank has just increased interest rates. Today, we're going to look at what it means for you if you're looking to buy a home, how it's actually going to reduce your borrowing power, if you own a mortgage, where interest rates are going, and more. So let's dive in. Jaden, let's start off with having a look at what it means for mortgage holders and where rates are actually going to go for the rest of the year and next year as well.
Yeah, so bank economists have made a couple of different predictions. I think the one thing that they're all agreeing on is that rates are going to go up. You know, with Westpac, they're saying rates go up 5 times. NAB are saying probably a little bit more conservative. CBA, etc. They're all a bit different. What we've done is taken Westpac's forecast of the cash rate over the next 2 years. So they're saying by December 2023, so by the end of next year, the cash rate is going to be at 2%. So I think one thing that kind of gets overblown at the moment is that people are saying like, oh, what happens if interest rates get to 6 or 7%? Am I going to be able to afford them? Are they going to get back to 13 or 14% like they were in the 90s? And I think the reality is, let's kind of take one step at a time. The Reserve Bank has no precedent on sort of pumping up interest rates to 6 or 7% overnight.
And I think, Jaden, having said that, we've got to remember interest rates on a normalized figure for the last 10 years has really sat around that 4.5%, 5%. So with inflation where it is, it feels like we're sort of getting more up to that normalized rate, particularly with this forecast here of Westpac predicting a increase to 2% in the next 12 months. It's also interesting when we look at New Zealand, our neighbours next door, they've actually had multiple rate rises really since October last year, where their official cash rate is 1.5%. Now we're still quite low, we're still under the 1% at 0.35% here, and it's something to keep in mind as well. But Jaden, did you want to run us through what it looks like with all these rate rises? Is it better to go fixed or variable right now?
Yeah, here's an example of using Westpac's modelling, looking at the cash rate today, obviously taking the most recent rate rise and comparing to say December 2023. If you were to say apply for a variable rate at 2.75 today versus a fixed rate of 3.79 on a $500,000 loan, if you fix, you'd actually be financially better off. You'd have lower repayments over that period compared to the variable rates because the rates could end up at 4.84%. So I guess, if you're looking at it, if it's a financial decision based on Westpac's modeling, which is not to say they're going to be 100% correct, it could actually be beneficial financially to fix. But I think it comes back to the real reason that we usually look at fixed versus variable is probably that stability, because no one's got a crystal ball. Like we've seen in the past, the economists, they're kind of like weathermen or weather people. They get things right sometimes, but not always. So I think at the end of the day, you probably just need to look at the repayments. And in this case, if the repayments today on your variable rate are $2,041, you need to be looking at, say, by December next year, your repayments could be $600 extra a month. So you need to be sort of factoring that in and sort of looking at and building a bit of a buffer there.
And I think the one thing, if you are thinking of fixed in, it really does give you that stability. So as Jaden showed in that example, there's forecasts for multiple rate rises. They've said another 5 for the rest of the year. So nearly maybe a rate rise every month or so for the next 6 to 12, I think we've got 7 months left in the year. So 5 more rate rises is what they're predicting. So if you're really after that stability and knowing exactly what you're paying for, fixed makes a lot of sense. Even in that example there, if you're fixing it at a higher rate at 3.79, it did make a little bit more sense in that regard from a numbers point of view.
Yeah, I think the other thing too is you want to build in like a bit of a repayment buffer. So if you can today and you can afford to say make that extra $500 a month in repayment, for a lot of people like that might be a bit of a stretch, but if you can, maybe even make an extra $100 a week in repayments, because every extra repayment that you can make potentially will build up there as a bit of a buffer. If you've got a variable rate loan, if not, you can have a savings account and sort of contribute a bit extra to your fixed rate. Usually you can make up to $10,000 a year in extra repayments, but where possible, you want to be sort of building in that buffer. For now, it looks like the rate rises are inevitable. They've started obviously this month. They're set to continue as sort of inflation, things keep going up until that gets under control. And sort of my point earlier, I think where people are getting a bit freaked out is like, well, how far can it go? Like, are rates going to get back to that 6, 7, 8%? And the Reserve Bank's sort of rhetoric has been sort of wait and see. Like 2 years ago, they were saying the rates were going to be on hold until 2024. Obviously, things have changed. The world's opened back up. Things are starting to normalize, like Nathan said. Interest rates to be normal have to be at 4 or 5%. Like where they've been the last few years just aren't probably normal. and that's how it needs to be. But the Reserve Bank knows that if they go too hard too soon and shock the market and things sort of slow down, then they can always bring the rates back and move things up and down as they've seen. But I guess your next point, Nathan, looking at borrowing capacity, how does the rate rise directly impact when you're applying for a loan? What impact does it have, and how does the bank's assessment rate work?
So effectively, it will reduce your borrowing power. So the more rate rises we see, we're actually going to find that your borrowing power is going to keep reducing. So what that actually means is a 0.25% increase on our workings is reducing your assessment rate and ability to borrow by about that 3 to 5% mark. Now, it does change from lender to lender because each bank actually applies a buffer to the actual interest rate you're getting. So let's say if you're getting a 3% rate right now, they put a 3% buffer, so the assessment is actually completed on a 6% rate. Now, with the increase that's recently happened, a 0.25% increase, that actually means that assessment rate has increased, which therefore reduces your borrowing power.
Yeah, so let's go through a practical example. This is from the Commonwealth Bank's actual website that's available to the public. So they openly advertise that they've got the servicing rate has to be 3% above the interest rate applied for. So if you're applying for a 3% interest rate at the moment, your assessment rate will be 6%, or a minimum floor of 5.25%. Now this is before the most recent rate rises, but I guess for illustration purposes, let's have a look at what impact that's going to have to your borrowing power. This calculator, again, it's pretty rough, but gives you a sense, based on the floor rate before the most recent rate rises, your borrowing capacity might be 545. With the most recent 0.25% increase, your borrowing capacity goes from 545 to 530, and potentially in 2 years' time, when the interest rates are 2% higher, hypothetically, your borrowing capacity goes down to $430,000. So it does directly impact your borrowing capacity. I guess probably the next question you might be saying is, well, how do I lock that in today? And you definitely can with your mortgage broker if you're, depending on the lender as well, applying for a pre-approval today. The banks can use the assessment rate today. So Nathan, do you want to explain how that works and how you can ensure that you can get some certainty and you're not getting pre-approved today, going to an auction and then missing out?
Yeah, exactly right. So especially if your borrowing power is quite low and you're sort of getting to your upper limit, there are lenders out there that will do a pre-approval and complete your assessment and assessment rate based on what it is today. So you can get that locked in. Some lenders pre-approvals are only for 3 months, others are for 6 months, so something to keep in mind. I think the other thing to keep in mind also is if you are looking to buy or you do have a mortgage, most fixed rates you're only fixing in for 2 or 3, 4, 5 years at the max. So you are going to find that there will be a point in time where your mortgage will go from a fixed period to the rate in which the market's at. So a good idea here is to do a bit of an assessment on your own position to understand your affordability and ability to budget in the future. We've got an example here where you might have a loan for $500,000. Let's say you're paying 3%. Well, jump on our website, huntergalloway.com /home loan extra repayment calculator. And this calculator here helps you calculate where rates would be if interest rates went from, say, 3% to 5%. You can sort of get a better idea and feel for what that actually looks like and where you're going to be positioned and what changes you might need to make in the family budget. So definitely one to think about, especially if you are locked in. There will be a point in time where that fixed rate will revert back to a variable rate and you will be subject to the changes in the marketplace.
Yeah. So I think you have to be careful of the media hype. Remember before COVID, there was going to be 40% property drops. It didn't happen. There was going to be, shock from people going into default because of the changing lending landscape. That didn't happen. Again, I think there's another bit of a media beat up. The Reserve Bank said the economy's actually never been healthier. Unemployment's at 50-year lows. Things are actually looking very good. So if you've got a home and you're looking at loan, potentially try and make those extra payments. Try and build up that buffer so you've got the extra money. Know that the rate rises are going to be inevitable. So like Nathan said, if you're fixed at the moment, maybe try and squirrel away a little bit more based on what the repayments might be when the fixed rate ends. So it could be 4%, 5% in the next 2 years. And if you've had an existing loan for a couple of years and you want it reviewed, we'd love to help out. So at Hunter Galloway, we're mortgage brokers. We help home buyers across Australia. There's no cost for our services. So hit us up at huntergalloway.com.au. And what do you think about the change in the rates, the changing landscape? Are you worried? Are you excited, I guess? Potentially it could mean property growth. Who knows? Leave a comment below. We'd love to hear from you.